Hey everyone, welcome to episode 67 of the What Do We Do podcast. With all that's going on right now, we all want to know, what do we do? Well, today's show is all about what to expect when you're investing. It's going to be a great show, so let's go.
Welcome to What Do We Do? A podcast discussing wealth management and financial planning featuring key leaders in our communities. Hosted by founder and CEO of Great Lakes Wealth, Dewey Stephan. Tune in to hear how you can plan for and live your best life.
Well, thanks again for tuning in, everyone. This is Dewey Stephan of the What Do We Do podcast, and this is season 3, episode 4, number 67. And with everything going on in the markets right now, I thought it would be a perfect time to give a podcast about what to expect when you're investing. So I thought we would start today's show with a history of the markets, okay? It's not just the stock market. There's the bond market. There's the real estate market. Heck, there's even now a crypto market. There's the housing market. There's the oil market. There's the gold market, the international market. I can go on and on. So when we're talking about investing, we want to first talk about what market or markets are we talking about. With all the anxiety out there, all the uncertainty out there, we're going to talk about the markets this year. And almost, if not every single market is down year to date. And they're not just down a little, they're down double digits. And so with this happening, everyone is worried. Everyone is talking about what do we do. We're going to talk about the short term and long term and what you need to expect when you are investing. First, you need to understand the long-term returns of investing. If you look at the chart, you'll see that in the last 20 years, the S&P 500 is up over 9% per year. This year, it's down around 25%. And if you look further, you'll see the best performing broad asset class over the last 20 years was, in fact, real estate. REITs are up over 11% per annum over the last 20 years. From there, you can see gold. You can see international investments, you can see oil, you can see bonds, and you can even see what the average investor has made, and we'll talk about that later in the show. And on the flip side, the only things that are basically up this year are interest rates and inflation. So as it relates to investing, that is actually what's been putting the pressure on the markets coming down. And so we're going to discuss how you manage through high inflation, higher interest rates, and lower markets. When you're investing, you also have to understand the psychology behind investing. It's a very well-known fact that investors tend to buy high and sell low. And in investing, to be successful, you really need to do the opposite. You want to buy low and sell high. But as you'll see on this chart, the typical investor thought process is really backwards. We go from optimism to euphoria, to anxiety, to panic, to denial, to depression, to hope, and back to optimism. But as you see, investors typically sell at the bottom and they end up buying at the top. And so we need to recognize from a psychological perspective that you cannot have your emotions get the best of you. They cannot rule the day. So as we've shown in the long term of just the last 20 years, all investment classes have been positive. And in the short term, this year, all investment classes are negative. So if in the long term they'll be positive and in the short term they are negative, it doesn't take a rocket scientist to understand you really want to buy low, buy now. So expectation number one, in the short term, you can expect investments to go down, and in the long term, investments to go up. So when you have an opportunity to buy investments when they're down, that is really the opportunity you're looking for. And right now, it's bonds, it is stocks, it is commodities, it is precious metals, it is even cryptocurrency. So we will dive into it further about what to do and where to do it. But for now, expectation number one, short-term volatility creates long-term opportunity. Expectation number two, know your time frame. On this chart, we very simply tell you there's a difference between investing for safety, investing for income, investing for growth, and investing for speculation. When you're investing for safety, you might want liquidity and you want preservation of your capital, and that should be short term. We always talk about 3 to 6 months of cash on hand for emergencies. That's safety. And then the income category, where you can catch dividends and live off of your interest, those can be longer than 4 years, but your investment time frame, you might want to consider it at least 1 to 4 years. And in the growth and speculation categories, that is high risk, high return. So you have growth potential as well as speculative 2x, 3x, 4x potential. But you have to sometimes let that little acorn go into the ground and then water it, watch it grow, a little sunlight, so your acorn turns into the big oak tree. It doesn't happen in a day. It doesn't happen in a month. It won't even happen typically in 1 year. So recognize that safety can be your short term, but growth and aggressive growth is absolutely a long-term investment expectation. So when we're talking about investing for safety, we want to talk about these things known as cash and cash equivalents. Those could be money markets. Those could be shorter term CDs. Those could be even fixed annuities. We want these investments to have a guaranteed return of your principal. Safety first. In the income category, we call it credit. We call it debt. And so with that, you're giving money to a person, a company, a vehicle, and they owe you your money back with interest. That's called an income payment, a distribution. That's called your monthly check. That's income. With that, you can look at corporate bonds. There are income mutual funds and ETFs. You can look at some REITs and you can look at some MLPs. You can also look at private credit and private investments that give you cash flow. On the growth side, you want to talk about stocks. You can talk about mutual funds and ETFs and even variable annuities. The higher we go up the pyramid, the smaller amount of capital you might want to put into these investments, but also the more risk there's going to be with these investments. Now, on the speculation part of the pyramid, you'll notice it's at the very top and it's the smallest piece of the pyramid. This is where you should put the smallest amount of your investment capital, but unfortunately, too many investors put this as the biggest portion. In this category, again, you should recognize that you could lose a lot, if not everything. You can also make a lot or more than a lot. So in this category are futures and options, junk bonds, small caps and micro cap stocks. Also this new category called cryptocurrency, cannabis. You have private equity, other investments with extremely high speculative risk. High risk can equal high return. But you also need to understand high risk can also equal big loss. The next expectation is to know your expected return. I love this chart because you can put your arms around what you should expect to make investing in certain investments. And just like this slide shows, the majority of assets should be safe, then income, then growth, then speculation. And as you look at each category, you should have an expected range of outcomes. If you keep your money in a bank, you should expect not to lose, but you also should expect not to make too much. So in the safety category, you should expect plus or minus 0 to maybe plus or minus 5%, depending on the exact amount of safety in that investment vehicle. On the income side, you can take a little more risk and get a little more return. But there's a difference between bonds and stocks, or between credit and equity. So in the income category, you need to expect maybe to lose between 5 and 10%, to make between 5 and 10%. The longer you're in, the more you should expect to win. And the shorter you're in, you should expect there could be a loss. The next category would be growth, and this is more of the common investing strategy, and you need to expect what's happening now is normal. It's not the expected outcome to be at a loss, but you need to expect that it will happen along the way. In this category, you should expect losses between 10 and 20% from time to time, as well as gains of 10 to 20% from time to time. So with risk comes reward. And right now, this is the risky period, and we expect that not too far down the road, you will get the reward period. And last but certainly not least is speculation. This is where you invest, we believe, small amounts of money, and if it goes well, it might be a pre-IPO company. It might be a small cap, which means small, brand new company. It's something that absolutely is not guaranteed. There is not a long track record, but small investments in big opportunities can be very, very substantial. But you have to understand the risks and invest accordingly. Okay, the next investing expectation is to know your goals. As we always say, if you fail to plan, you plan to fail. What are your goals? Write them down and make your plan. We call it goals-based investing. Your needs, what are they? Your wants, what are they? And your wishes, what are they? Okay, so once you determine what your goals are, we call it portfolio construction. So in this process, you start with set your goals, which are objectives, and then develop your investment plan, which means figure out how much should be in safety, how much in income, how much in growth, how much in speculation. And by doing how much in each category, that's considered asset allocation, also known as the pieces of the pie. And as we always say, make sure you reach out and talk to your investment professional. Don't go it alone. Use the tools and calculators out there on the interwebs, including ours at greatlakeswealth.us. But once you figure out your asset allocation or your pieces of the pie, then you have to decide what will go into each of those categories. And that is called picking investments. Are you going to use ETFs? Are you going to use individual stocks? Are you going to buy bonds or mutual funds? Again, it's not very complicated, but it is complex. And finally, you always need to review and rebalance, and then start the cycle over, whether it's quarterly, semi-annually, or annually. You need to review your plan and absolutely rebalance your plan from time to time. Okay, so after those 4 expectations have been met, your 5th and final expectation should be to expect success. With the power of diversification, which is what we talked about earlier with what are we investing in, for how long are we investing in it, and what is our expected investment returns, we can anticipate in the short term, we may have a loss, but in the middle to long term, we should in fact have a gain. What we haven't talked about today is that in the different categories, the amount of time you have to wait perhaps is longer, and the amount of time you have to wait is shorter for your success. The cash equivalents, the income investments, you should expect any losses there to be shorter in nature, and you should expect that if it's growth or speculation, you should expect it may take years until you see a profit. Okay, so when we talk about diversification, you'll see on this slide, I put 2 investors. Investor A, who just finds an investment for the long term that returns 8% per year. On the earlier slide, we showed that the S&P, in fact, has been up over 9% over the last 20 years. So I think it's a pretty fair comparison for using the S&P. And if at an 8% return, your $500,000 over 10 years will in fact double to $1.079 million. And I know you're thinking at simple interest, 8% on 500,000 would be 40,000, and over 10 years that would be 400,000 of gains, which would be a total of 900,000. So as a sidebar, this is also the power of compounding. 8% compounded is not 8% simple interest. So you have an extra 179,000 also due to compounding. The other investor, investor B, who went with some safety, some speculation, some income, and some growth, ends up with a marginally better percentage return per year. If you do the math, it's actually 8.3% per year instead of 8.0% per year. But because of compounding, you end up with 1,339,000. And in this scenario, break it out. 100,000, complete loss. Speculation goes to zero. Another 100,000, speculation. You do very well. 20% return per annum. That's successful speculation. The other three investments, one is in safety. You earn nothing on your money for 10 whole years. The other two, you earn 8% and 15% respectively. So this goes to that whole be diversified and don't keep all your eggs in one basket. This example shows truly you can invest for safety and speculation, and you will have a successful outcome. You need to understand that there are very significant advantages to being diversified. But again, talk to your investment professional and make sure that when you invest with the right scale and the right sizing of your investments. Okay, well, that was the 5 main expectations of investing for today's show. But I'm in a good mood, so I'm going to give you all a bonus. Okay, so how about this? The bonus expectation is the following. The only thing guaranteed in life is death and taxes, and the expectation that your investment portfolio will, in fact, go up and down. Well, with that, I want to thank you for tuning in to another episode of the What Do We Do podcast. This is Season 3, Episode 4, number 67. And as we always say, live your best life, be radically generous, a great big booyah to ya. And just so you know, we are over 50,000 downloads, 1.3 million total views on social media, and we're just getting started.
The opinions expressed in this program are for general information purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. It's only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risks and possible loss of principal capital. Please seek advice from a licensed professional.